Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week. You know, you can see us, hear us, and find us in all kinds of places. One of the places that you can see us is on YouTube. If you go to YouTube, Jeff Barton, the Mortgage Voice, I am there, and I am here today. And this particular show will be on this weekend. Now, we have hundreds of shows. And if you want to listen to some back shows, you can always go to The Mortgage Voice. And that is a website. Our website is themortgagevoice.com, and you can see our guests, the guests that appear on the show. On YouTube, you can see them there as well. You can contact them directly. You can find out who they are, what they're doing, as well as all the shows on YouTube. We also do this weekly 1 minute. It's actually Mortgage Minute. We call it the Mortgage Minute. It's usually about mortgage 5 minutes, but it's on LinkedIn. It's on Facebook. It's on Instagram, all the social medias that people tend to want to go to for information and entertainment. Anyway, if you go to all these places, sign up. Say that you like it. Make sure that you click on join so that we can tell you what's on and when it's on, and alert you for those type of shows that you want to hear, which is about the mortgage industry, about the real estate industry. And we've been doing this show for 10 years. So again, I'm Jeff Barton. This is The Mortgage Voice. And again, thanks for tuning in. Okay, let's get right to it, because I think there's a lot going on in the mortgage market in terms of rates and what we've seen over the last 10 days to 2 weeks. The 30-year fixed rate is 6.25%. The 15 years at 5.4%, 5.55 is the jumbo, FHA rather, 5.70 is the jumbo, 5.20 is the jumbo, and 6% is the 5/1 ARM. The 2 year is at 3.49, the 10 year is at 3.33, 16 basis points. The flattening of the curve is happening, although, like last week, we are seeing a rise in the overall yield for Treasuries. Now, what does that mean? It means that the demand is down, so they have to pay you more in order to buy U.S. debt. Why is that happening, and how is this affecting decisions being made both in the economy with people who make those kind of decisions, the Fed? What are they going to do? Are they going to raise the particular short-term interest rates, which affect your credit cards, your car loans, commodities in general? It is tangentially effective for the mortgage interest rates as well. So when you're in the marketplace right now and you see a jump from, last week we were probably 75 basis points less than 6.25% in certain respects to the 30-year fixed rate mortgage. That's an amazing jump in a week, isn't it? Well, the uncertainty going on in the market, in the economy, is pushing interest rates up. Either the interest rates are going up because risk is going up, or because people see that the end result is a cooling, i.e. inflation. Inflation is what really is the main driving force behind what the Fed's doing, but what is your mortgage interest rate doing? And how is it that 6 to 8 months ago we were at 2.5%, 2.75%, and today we're at 6.25%, 9 months later? It's quite a spectacular rise, as everybody knows it. And what are we to do about it? Well, we in the mortgage industry, and I'm talking about everybody from mortgage loan originators to banks to escrow companies to title companies to inspection services to everybody in between who is in the mortgage business. Let's just look at a few companies out there that you may be familiar with. Citi trims mortgage workforce. That's one of the headlines. Rocket offers buyouts again. Yeah, if you want to retire or if you don't want to retire and you're an executive there, they'll buy you out of your contract. Maybe even the loan originators they have going there too. HomePoint lays off 100. Amerisave exits wholesale. Sprout and First Guarantee, everybody knows, they went out of business. There's more, but just to let you know that the effect on companies that you've come to rely upon when you're going to a mortgage. Now, obviously, nobody's doing a refi right now unless you need cash out refi. And we're going to bring on to the show today Laurie Preedge from Spring EQ just to talk about what's happening in the second mortgage market. I mean, obviously, if you have a 2.5% to 3.5% mortgage on a 30-year fixed, even really last month when we were at 4.5% to 5.5%, you're not going to want to get out of that to take money out of your property. No, you're going to look at a different type of property. You're going to look at second mortgages, or you're going to look at a HELOC. All of that is so you can maintain what you have in place already, which is an extremely low, historically low, never happen again low in terms of your first mortgage lien. Now, a lot of these liens that come later, i.e. the HELOC or the second, they have stipulations to them if you want to get out of them, if you want to use them, what happens if you don't use them, is there a fee? All of these things Laurie's going to talk to us, because I think it's important that you see that there are options for you other than getting out of that super great low mortgage that you're currently in. And millions of Americans absolutely want to take advantage of this equity that they have built up in their house. Why? Well, you might have bills that you've built up, or you might have payments that you want to make, college and all these other typical things. But realistically, if you have equity in your home today and your price and the equity in your home drops because the value of your home drops, well, you have now just lost all of that particular capital that you could have taken advantage of had you done some kind of refinance or cash out refi. And the cash out refi I'm talking about is, of course, a second mortgage or a HELOC. That money can be used for all kinds of things. If nothing else, put it in the bank and let it sit there. Now, we've seen inflation coming down. What does that really mean? We've seen the edges and the bits around the corner. Now, I've read articles that have said we are going to see a inflation rate drop like a rock. What does that mean? Well, we're currently at 8% plus. So drop like a rock. What does that mean? To 6? To 5? We were at 2.5 years ago 2%, and they were hoping that we could get inflation up to 3% for a while, because that's what we were calling for in terms of wage increases and wage inflation, which means once that inflation cycle started, 3% looked like a good idea. Well, now 3% seems like a faraway thing to me. I don't know. Let's look at some other things going on in News to Use section. Let's see. The dates rise, apps fall. Yep, that's right. The rates rise, the apps fall, and the industry braces. That's what we're talking about. The industry's bracing. And what that means is the overcapacity built during the pandemic is now coming home to, pink slips. And pink slips probably through the end of the year. We're going to see a lot of these big companies, whether it's Wells, Bank of America, Citi, Chase. They're all going to lay off a lot of these mortgage people. But you're also going to see companies that aren't depository institutions like Rocket and United Wholesale, were the two biggest originators in the country. They're laying people off. I already mentioned Rocket, but UWM's going to do it too. There are a lot of ways that if you are out there and you're listening to me and you're saying, okay, this doesn't sound like great news. Well, there are some great news. There is some great news, rather, in the mortgage market. One of the things about the mortgage market when we tend to see rates rise is we see new products. And a lot of the new products that they're rolling out, I'm actually supposed to be on a call tomorrow with, what's his name? Over at Rocket Mortgage. They're rolling out a whole bunch of new products to try to entice people, even in this high interest rate climate, to come and get a loan with Rocket. Now, one of the things that is always a subject of anxiety in any one of these markets that are up in terms of the interest rates is, are the loans any good if we're going to introduce new products, i.e. newer non-QM products, DSCR, bank statement, stated loans? Are all those loans? Well, one of the things that we look at, and one of the things that really affects your rate more than anything else, is your credit score. Well, we've seen the credit score of the average borrower during the pandemic, and it's about 717, and that's pretty good. That's a pretty good credit score, and that we have seen really almost exclusively. We've seen over 700 since the pandemic of 2008, and borrowers have really honed in on getting that credit score really good, and also a lot of borrowers who are doing purchases are saving their money. So borrowers are coming to purchase with good credit score and money down for purchase money. Those two aspects mean that the loans themselves are going to be good. They're going to have a good track record in payments. We have seen an uptick in defaults. That's true. We have seen early payment, not early payment, but notifications going out for late payments. We have seen that tick up a little bit, but for the most part, it's been pretty solid. Anyway, I'm Jeff Barton. I'm going to get to you on the backside, talk some more about this stuff. We'll be right back. I'm Jeff Barton. This is The Mortgage Voice, and thanks for tuning in.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know, each and every week we come to you. We also are on a number of other different outlets. I wrote them all down the other day. And, you know, if spread out all over, wherever you are, however you're going to listen to us, one of the great ways that you do it, obviously everybody does this, is they surf the net. Well, if you surf the net for us, we are themortgagevoice.com. Themortgagevoice.com houses not only the radio show, but some profiles of a lot of the guests that we bring onto the show, and you can also get in touch with them via that particular method. That's themortgagevoice.com. I'm Jeff Barton. This is The Mortgage Voice. Thanks for tuning in. Okay, so we bring experts to the show, and we bring people from all over the country and all kinds of different disciplines to be able to give you information about what's happening out there. It's and I've always said it, it's true. Real estate is micro. It's about what's happening in your neighborhood. But the mortgage industry and what's happening globally all over gives you a perspective so that you're not tunnel vision when you're going in either to buy a house or do a refi. In that vein, from New York City, that's right, Lynda Rosenthal joins us. She's an agent over at Compass, and she's here from New York City. Lynda, how are you?
I'm good, Jeff. How are you doing today? Thank you so much for having me on your show. I'm very excited to chat with you.
Thank you, and thanks for coming on. I know you've been in real estate in the city for about 20 plus years, and I'm guessing, but I'm sure that's right.
That's right. I've been doing real estate for a long time, seeing very many different markets and watched the business change dramatically over the years.
Yeah, and that's what I wanted to talk to you. Now, we know New York has a ton of rentals, and rentals out here in Los Angeles, where I'm currently based. Now, we have radio stations in Albuquerque, in Tahoe. We're in Las Vegas, as well as Southern California. So we have a pretty wide reach in terms of people understanding the difference between rentals and purchases. But give us a perspective of what the rental market is like in New York if someone wanted to move there and get an apartment in one of the boroughs. Let us know what's happening.
Absolutely. Well, I specialize in Manhattan. I am a Manhattan broker.
Okay.
Brokers tend to specialize in areas in New York. And for many years, I worked in relocation, so I got to really get to know all of the city and all of the different neighborhoods. So I became very specialized. Somebody had something in mind, like if they wanted a building with a terrace, or they had a dog, or any of those kind of things. I basically, over the years, got to be very knowledgeable about what different buildings have. But that said, Manhattan really is a place unto itself. All the management companies are very different. We have 1 million management companies. We have many, many individual owners that rent out their properties. So every apartment is like a completely new situation. So that's why in Manhattan, unlike maybe some other places in the U.S., you really do need to work with a real estate agent because it's very complicated, and we do board packages for rentals that it's almost the same as if you were buying the apartment.
It's interesting.
So it's a lot of information.
There's a lot of information, and I've always thought that buying real estate shouldn't be so complicated. Renting real estate should be easy. It's not in the city, and I know that because of the fees and the different ways that you look at rentals. Give us an idea of some of the prices that people are paying now for rentals in New York.
Yes, absolutely. Well, one bedrooms are starting around 5,000, and
Wow.
two bedrooms are around 8,000,
Mm-hmm.
and three bedrooms are around 13,000. And these are kind of starting prices. I
Wow.
mean, you get
Yep.
more into the most expensive areas in Manhattan, which would be the West Village, Soho, Tribeca. Those have always been areas that are a little more expensive. You're going to pay more than that. So, people come here and they're used to living in a lot of space.
Right.
They see these prices for these very small apartments. And then, of course, they have to qualify. And in New York, a lot of the buildings will use a qualification where you have to make between 40 and 50 times the rent as income. So this becomes, a lot of income. So
40 to 50 times per month, you mean, or per year?
per year. So your income has to qualify basically on a 40 to 50 times the rent as income.
So let me just math that for you. So if you're paying $8,000 a month, that's basically $96,000 a year, and you're saying 40 times to 50 times that in order to qualify?
Yes. Yes.
And there are people that do this readily.
Absolutely. And we only have a 1 to 2% vacancy in Manhattan. So a lot of people, qualify for these apartments.
Right.
If they don't happen to qualify, then you can have a guarantor, but your guarantor has to make 80 to 100 times the rent. So Manhattan is a place unto itself as far as pricing. And right now, with the sale market, a lot of people are opting to rent for another year.
Right.
They're, unsure between the mortgage rates and, everything that's going on in the world. They just feel that they would be safer renting. So we have even less availability in apartments. And there isn't a lot of new construction that's coming to the market. So as usual, we always are very short on inventory, and that hasn't changed. And apartments come on the market, and they go within. I just had an apartment myself that I put on the market, and within 5 days, I got the full asking price for it. I had 2 or 3 people that wanted it. I didn't step foot in that apartment. I rented it basically with a video.
Wow. Hey, now during the pandemic, a lot of people left New York. Yes, but it sounds, based on what you're telling me, that everybody came back and then they brought all their friends. So
that's right. Everybody came back and more.
Oh my gosh! And a lot of the inner city office buildings, is there just? And you may not know the answer, but I'm just guessing that the vacancy rate in office buildings is a lot different than the vacancy rate in residential.
Yes, it is. Absolutely. Yes, that's a different. I don't specialize in that, but
right.
I do. I just know that's true. Yeah, people are still working remotely a lot, even though they're starting to come back to their offices more. That's still a different market.
Yeah, it is. And okay, so when you're out there showing or when you're out there listing, where do you get your clients? Is it just old clients? Because in most markets there's a thing called mailers for the farm that you have, whatever the farm you have. You don't do that in the city. You're not walking down the street with a sign. How do you get your particular clients? Is it just through the referral business that you did for years? You just know a lot of people, or how does that work in that city?
Yes, mainly referral business, and from that, you establish yourself over the years, and then of course, people come back to you and they bring their relatives and friends, and you build relationships, and that's how you build your business. And we advertise, and we really the rental market is just so fast that things just go very, very fast.
Okay, so with the rental market the way it is, and obviously no new construction, and we're looking at, I guess, the purchase market as strong as it is, Manhattan has become or is kind of priced out of the market for a lot of people just trying to come to New York. Where do they go if they can't afford that?
Well, that's a good question, because Brooklyn is also very expensive. It isn't far behind Manhattan as far as pricing in some of the areas. I think that people are going further out. They're going out to Queens more. They're going more to different, maybe Staten Island, maybe up towards the Bronx, those areas. Just opening up, more easier, further away from the city, but still easy enough to commute with either a subway line or something
Right.
like that.
Lynda, we are up against it. Could you let people know how they can get in touch with you when they need a terrific agent, knowledgeable person in the New York City area?
Absolutely, I'd love to. It's Lynda with a Y, dot Welburn, WELBURN @compass.com. And that's how you can reach me. Any question, I'd be happy to help.
Excellent. Thank you very much. Thanks, Lynda. I appreciate you coming on the show.
Thank you.
Let's
Thank
do it
you,
again.
Jeff.
Okay,
Thanks.
excellent. That's
Yeah.
Lynda Welburn from Compass Realty. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You can hear this show a lot, and we're all over the place here on the West Coast. We're trying to get some East Coast affiliates, but at the moment, we're in 5 radio stations in 3 different states. We're on KTHO at K-Tahoe, up in the Tahoe area of California. In Southern California, we are in KMET and KCAA, 2 great stations in San Bernardino and Riverside with some reach out here to LA and Orange County, as well as Ventura counties. We're down in Albuquerque, New Mexico at K-Mine Country, and we're in Las Vegas, Nevada, AM 1400 at KSHP. If you want to hear our show this week or any week, those archives for those radio stations will get you there. We're also on some podcasts. We're on YouTube. We really can be heard or seen everywhere. But if you do tune us in, say that you like us. The more you like us, the more we can get information to you about mortgages, about maybe taking some equity out of your house, which leads us to our next guest. And Laurie Preedge from Spring EQ has been on the show several times, and she joins us again now to tell us a little bit about what's going on over at Spring. Laurie, how are you?
I'm good, Jeff. How about yourself?
I'm okay. Thank you very much. It's hot here in Southern California. For anybody who doesn't know that, 100-plus degrees, and I wish the mortgage market was as hot, but we had our time in the box. What's happening at Spring that can take advantage of some of this equity that people have built up in their houses?
Well, it is hot at Spring EQ, that's for sure. We've been super busy since early March when interest rates started going up on the first mortgage side.
Yep.
And we expect to see busy going forward for the next few months.
I totally agree. Yeah. Tell us about, so tell us first of all, because there's a lot of people that don't know your company. I mean, we do here on the show, but tell people what Spring EQ does and how you may be able to solve some of the cash flow problems that people have if they own a home and have some equity.
So Spring EQ offers 2 different types of second mortgages. We offer fixed rate seconds, which are fully amortizing. People would call them like installment notes.
Right.
And then we also offer home equity lines of credit. So different products for different situations and different kinds of people. There's not like one catch-all product for all types. But we do offer both products, which makes us a bit unique because most banks or credit unions offer only HELOCs.
Right.
But we do have the fixed rate closed-end option as well.
Give us a typical customer that would come to you. I know there's no such thing as a typical customer, but give me an idea of somebody who would say, hey, you know what, maybe this is for me.
Yeah, I agree. There's no typical customer, but basically anybody who wants to have access to their home equity and they don't want to touch their first mortgage is the perfect customer for us.
And you're seeing what kind of credit scores with these seconds? Obviously, somebody with a 2.5%, 3% mortgage, no, they don't want to touch that. But if they're coming to you, what are the criteria in credit score? Maybe some of the income criteria that you use?
Well, so we go up to 90% of the home's value.
Okay.
That's called the CLTV. So we can go up to 90% of the home's value. Our typical client has a 680 credit score or higher. We do have lower credit score options on the fixed rate product, but on the HELOC, 680 is our minimum credit score. And then depending on where the borrower lives, which state, the rates on the lower credit scores could exceed state lending rules.
Okay.
So while we do offer lower credit scores, we do have to worry about what the state's requirement is from a high cost perspective. So not everybody with the credit score under 680 would be able to get a loan depending on where they live.
Right,
I know that's a little bit confusing.
Yeah, well, confusing in that people don't really understand how rates work and how getting a loan may be different in one area or one product versus another product, but you throw on top of that a second or a HELOC, then people get very confused. What are some of the disclosures that you might want to share with people to help them really understand what this is in terms of product and how it differs from a first?
Well, if you're doing a HELOC product, the state requirements for interest rates don't really apply with the exception of a few states. But the HELOC is an adjustable line of credit, and I equate it to being like a credit card tied to your house that you can use and reuse those funds over. And on that product, we issue a home equity line of credit disclosure.
Okay.
It's very similar to like a credit card disclosure would be. And then on the fixed rate product, that has more standard mortgage disclosures involved, and that would be a fixed rate, fully amortizing loan, so the rate and payment will never change. And what we're seeing in this market is that a lot of people that were interested in HELOCs are shifting over to the fixed rate product, so our product mix and demand has changed a lot over the last few months.
Okay.
So we're getting a lot more people interested in the fixed rate product.
Okay, tell us about that product. How would I qualify? I own a home, I have a mortgage, I owe about 50% left on the mortgage. How am I going to qualify if I've got some equity in my house?
Well, do you mean from a debt ratio perspective, Jeff?
From any, let's say I'm just a borrower listening to the show and I'm saying, hey, I want to do this. What do I do to get started?
Well, you would reach out to your mortgage broker or, contact Spring Q, either one. Those are both options. We do require full income documentation, so
Okay.
we're not doing any type of stated income or bank statement type product.
Okay.
So we're going to ask for 2 years W-2s and current pay stubs. We don't need to see any assets. We're going to order a drive-by appraisal on your house, and we're going to calculate your income to expense debt ratio to make sure that you can handle the added debt load. It's really kind of too complicated to get into too much more detail than that.
Right.
But it is very similar to getting a first mortgage on your house from a paperwork perspective.
Okay, but that does explain a lot to it. I know that appraisals themselves have been difficult on firsts, and I know that in the purchase market, especially when we're seeing some give on prices, maybe some give on appreciation. How is it that your appraisals differ, or do they differ? And then how do you order the appraisal, and how does that particular piece work?
Yeah, so the drive-by appraisals are different than paying for a full appraisal. There's no interior inspection on the property, and the cost is much lower. We charge a $149 fee for that.
Okay.
But because the appraiser is not staying inside of your house, you're not going to get the same kind of value that you would get if an appraiser went in and looked at the house. So the drive-by appraisal is better for people who owe less on their home compared to how much it's worth. We always will allow a borrower to pay for a full appraisal if they think that they need that to get the value that they need. But the drive-by appraisal is just a much more modified, quicker,
Sure.
or I shouldn't say quicker, but less work for the appraiser. So you're not going to get the same type of results.
And in the appraisal side, when you're looking at properties, your judgment of the worth of a property versus the appraisal, do you have a percentage that you go off of for a second, or do you use the full appraised value?
No, we use the full appraised value.
Yeah, so in some markets, especially with some lenders, they're now giving a little shave, a little haircut to the appraisal, and then they'll lend on that, just depending on the strength of the borrower, the strength of the property, the neighborhood. But in your lending on these seconds, you're taking the full appraisal value. That's a good thing.
Yeah, we'll take the full appraisal value. Absolutely.
Okay.
We are starting to see values coming in a little bit softer.
Right.
So that's good for people to know. We've kind of peaked, I think, and we're not seeing the month-over-month growth that we were before.
Right. I agree.
So we ask the clients, what do you think your home is worth? And we get an answer, but the value that we're going to get is not necessarily going to agree with what the customer thinks their home is worth. now
Wow.
that the market's softening a little bit.
You know how sellers are. They all think their property is worth more, especially in a market. Now, we're going to see appreciation, but not like 20% a year, maybe 5-6% a year. It's a little bit different.
Right. It's not the crazy days of last year in 2021.
Right, exactly. Okay, so we're almost up against it. I want to get people your telephone number or contact information so that if they want to talk to you about one of these great products, they can reach you. How do they do that?
My number is 949-610-3379, and I'm in California as well.
Okay, excellent. This is Laurie Preedge from Spring EQ. Now, we're in several states. How many states are you lending in currently?
We lend in 40
Oh.
states right now.
So pretty much the lower 48 or pretty close to it.
Yeah, we don't lend in Hawaii or New York,
Right.
Massachusetts, and some of the northern middle of the country states.
Okay, Laurie, thanks very much for coming on. I appreciate it. You're a problem solver, somebody who can really, make things happen with these type of products. I appreciate it. Thanks for coming on again.
Okay, I'll talk to you later.
Okay, thank you very much. That's Laurie Preedge from Spring EQ. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show, for tuning in each and every week. You know, we really love to have repeat people come back to the show. And to do that, if you miss a show, go to YouTube. Jeff Barton, the Mortgage Voice on YouTube is a great place where you can not only see the current show, but you can also see past shows you may have missed. Now, we see a trend going on in the mortgage industry we haven't seen in many years. Like a lot of things going on both in the country, but certainly in the real estate and mortgage area, things are just strange, different, new. And so to stay on top of it, you really have to tune in. And the best place to do that right now is Jeff Barton, the Mortgage Voice on YouTube. I am Jeff Barton, and I appreciate you coming to the show. So we bring great guests to the show. George Gonzalez joins us, and he's been on the show many times. He's kind of a go-to guy for what's happening out in the IE, Southern California. George, how are you?
Hey, Jeff, how you doing?
I'm fine, thank you. How are you?
Oh, man, I can't complain. Another sunny, lovely, beautiful, hot day.
It is a beautiful hot day in Southern California. We finally caught up with the rest of the country in the heat index. Man, we are just frying out here.
I hear you. Just try to stay inside and stay hydrated, right?
Exactly. Okay, so your customers, are they happy or are they angry? What's going on with your customers?
Well, Jeff, in our business, we're always the bad guy. But you know what, Jeff, our job as a loan officer is to keep them assured that we're going to do the best for them, and we're going to get them the best rate as it is, and we're going to find them the best program that fits them and their family's needs. Right now, as you know, last week we had the rates down. We thought we were on a rally down
Right.
to 5.75 on the 30-year fix for our best buyers. Today we're looking at probably about 6.25.
Yep.
And so we're just, some of my buyers, they're just kind of wondering, should we buy now? Should we not buy now? But I just give them the same advice, that I give everybody is, hey, if you're ready, why not? Why not if you're ready? Because it's always a good investment to buy a house.
Always. And I think that, as we've often said on the show, there's only one way to really get rich in America, and that's with real estate. I mean, if you're just a normal Joe who's out there, or normal Sally out there working, and you're trying to, raise children and do all the things just to enjoy your life, building equity in your home is the only way you can really secure wealth. And so, as you said, buying something, getting into the market, can you afford the monthly payment? Is that really the focus of what you're telling your borrowers now?
That is correct, Jeff. A lot of my pre-approved buyers right now, they have the down payment sitting in their bank. They have excellent credit. They have the income that fits the debt-to-income ratio parameters. Right. It's just a matter of them agreeing, on pulling the trigger. What I see though, obviously now is they're seeing, because most of the buyers, or some of them, been looking at the houses that were for sale, and then now they're still listed 30, 45 days later at, 10,000 cheaper or 15,000 reduced prices. So I think they're seeing that kind of trend. That's kind of holding them back too. Maybe they're thinking, they're going to wait a little to get it maybe at the best price they can. But, that's what I'm seeing right now.
Yeah, I think the real estate market is, something that everybody's watching. They're looking to see, and sellers do this too, they're looking to see where the market's headed. Now, we've seen price reductions all over the country, especially here in Southern California. Riverside specifically was a area that was mentioned as one of the first to actually start cutting prices. Have you seen prices in Rancho do the same thing?
Yes. Prices have come down. I'm seeing more of the inventory, more listings popping up that weren't there before, and I'm seeing closed sales. Actually, they're closing, but at a lower price than what they're asking.
Right. No, yeah, I see that too, and I think that is one of the things that people also get worried about, because they're saying, hey, is this 2008 all over again? And I assure people it is not. Credit scores are over 700. Amount of money into a deal is usually at least 10%, if not more, and of course we have equity in every home. Is that what you're seeing as well?
Yes, sir. That's exactly, and what I'm telling people, the same story is, listen, if we were in 2008, you're going to see the 80-20s.
Yep.
The 90-10s where people, you don't even need credit, you don't even need income, you don't need a down payment, and they're going to give you a house. Then it's time to run.
Right.
That's when it's time to run.
Well, they had those products, 228, 327. People are like, what the heck is that? And, of course, we know it was an adjustable rate mortgage on a 3-year fixed and a 27-year adjustable. Well, they don't have those anymore. And so this particular market, and by the way, it's actually very hard to get all the documentation together. It's stricter, isn't it, now to get a loan than it was?
Oh yeah, they're picking teeth. They're really scrutinizing every loan that's submitted in there. Those underwriters are giving no breaks. It's little verbiage that could mess up your deal. Paperwork that the borrower can't provide. One paper, out of 100 papers, documents, they only need one. They're still not letting it go because of that one. 99 went through, but not the one. So that's what they're doing.
Well, I think on the reverse side, it's very reassuring to people who are buying, knowing that they're buying into equity that they will probably get this year, and it will probably keep this year. Why? Because the loans are good. They're backed by solid borrowers who aren't just bailing because they may see a negative drop in their particular equity over the next couple of years. They're strong borrowers. They understand 5, 6, 10 years down the line, prices are obviously going to increase, and that's the reason to be optimistic in a market like this, because that's what kind of loans they are in a market that's still is short 1 million to 4 million houses nationally.
Correct. And like you said, Jeff, now people have a piece that they put some of their own, at least put 10% to 20% down, so they don't want to just run from the money they invested plus the little equity that might have built up or whatever it might be. Just wouldn't be smart, So that's why I think what I'm seeing is the adjustment is we're just adjusting, and eventually once the rates settle, whether they're going to be 6.5, 6.25, I wish they would just do it all at once and get it over with so we can go with it, But I think that's what the most of the people are waiting for, is just to see where we're going to fall at on the rates.
It's almost as if the way we're watching rates kind of go up and down is the way many things in this country are. We're just kind of going up and down here. And whether the rates settle at a low in the 5s or whether they, reach in the high 6s, it's not quite certain what that's going to be. I think the Fed's trying to control inflation, which is a good thing for people on fixed incomes and stable, so that we can say, okay, this is the rate.
Right, exactly. And the thing I try to stress to the buyers right now is don't focus on the interest rate.
Right.
Focus on that payment. If you can worry about the payment, don't get into that, interest rate game. Just look at the payment, and if it's a payment that you're comfortable with and you can pay, you don't have a problem, and you're okay, then who cares if it's a 10% rate, because you're comfortable with the payment. That's all you care about is the payment.
That's great advice, and I also think that employment is still pretty good for most people. We don't see job losses. I don't know what's happening in the job market out there in your area in the IE.
No, I see, people, job openings everywhere. I see,
Right.
Raises. I'm hearing about raises. Jobs are paying a little more because they want a little more quality of employees.
Right.
And so, you have to pay. If you want the quality employees, you want the quality work, if your company making money, you got to pay for the quality because you want to provide that for, your customers.
Right. I see a couple of the indexes that came out this week just talking about consumer spending and how it's really buoying the economy. So that's a good thing. We don't want to see a recession. We'd like to see inflation under control because that would also calm people and maybe also calm the interest rates.
That is correct, and like I tell everybody, and my wife too, she's like, honey, what's going on? Are you sure you're in the right, so
right.
often she says, you sure you're still in the right business? 'Cause she sees how hard we work, Jeff.
Yep.
Nobody sees in the dark,
Of course not. It's all, we're making tons of dough and it's easy. Well, it's not that easy right now.
I wish,
Yeah.
And I just tell her, look, man, we don't focus on that. We focus on helping families. If we keep our
Right.
focus on helping families, that's all. That's what I got in the business for, is to help families so that they won't get ripped off by other lenders, the sharks that are really out there.
Right.
There are. And, my job was to just take care of the family so I can run them through the process as best they can.
Thanks, George, very much. Could you tell people how they can get in touch with you if they need a terrific loan officer out in your area?
Yeah, my number out here in the Inland Empire, Rancho Cucamonga, is 909-900-9565.
George, thank you very much. Once again, great talk. I appreciate the information.
Thank you, Jeff. My pleasure.
Thank you very much. That's George Gonzalez from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week. You can also go to our number of podcasts that we're on, and I think Daryl has a list of those podcasts.
I sure do. It's Apple Podcast, Google Podcast, Spotify, Spreaker, Stitcher, iHeartMedia, Audacity, Odyssey. Oh, I don't know that one. YouTube.
I don't know that one either. But
Podclips.io and The Mortgage Voice.
Excellent. If you go to any
YouTube.
From YouTube, yes. If you go to any of these places, you can sign in, sign up. You can say that you like it. And the most important reason you do that is so that you can get the alerts as to what we're doing and when we're doing it. And that is important because as the world changes from an inflationary climate to a high... to raising interest rates either at the Fed or in the mortgage market. Once we go from one market to another, a lot of things change. And your opportunities really lie in your ability to understand what those changes are and how to take effective advantage of all of those types of change. I think that that's what the show does, and I think for you to come to us, we're very happy and happy to give you that information. So come on board. Sign up, and we'll be able to bring you the show ASAP from any number of these great podcasts. Podclips.io, by the way, is a great place to go for all kinds of pod clips, whether it's lifestyle or finance, sports, whether it's health, all of these great shows. And it's also a new place where podcasts are being housed. So go there, podclips.io. I'm Jeff Barton. This is The Mortgage Voice. Thanks for tuning in. Okay, a lot of things going on. Let's get to a couple more things in the News to Use section. Let's see, the slowdown in price appreciation. Yes, that's happening. One of the things that I think in another section where I talk about some reasons why maybe you should buy right now and think about buying more seriously than you have been is that price appreciation is falling. It's still there, but it's not at 20% a year, meaning that a price you were going to pay last year when you could barely afford it is now 20% higher. Well, that's really fallen off. We're looking more at anywhere from 5 to 10% by the end of the year for the year. Now, right now, we've seen a fall from 22% all the way down to 10%, and that 10% price appreciation, which is historically high, is really cut in half from where it was. So I think the price appreciation thing is going to be a good indicator of when is a good time to buy a house. Okay, a couple things in the economy which I think are really telling, and why the Fed will probably raise another 75 basis points. The services index are up. That means the industries like the restaurant industry, anything that requires somebody to help you at a store, services industries overall, the index is up, meaning they're hiring. The employment index is also up. The employment index sits at 50.2%. Now, what does that really mean? Anything over 50 means the economy is expanding. And we've had this debate, right? I've had this debate on the show. I've talked to a lot of people. If you go online and talk politics, one group will say the economy is crashing. We need new leadership. The other group is saying, no, the economy is doing fine. We're not in a recession. Now, I don't know what the technical definition is. Actually, I do. It's 2 straight quarters of negative GDP, which we've had. But with this type of indication at 50.2%, which means the market is expanding, what does that mean for inflation? And we won't find out till the third quarter. But we need to continue to look at the indicators. Employment, although was, what was it last month? The employment was pretty good figures. 350, jobs report, 315,000 jobs were created. Now that's a pretty good report. In most cases, that would be considered positive news. But because it wasn't greater than Wall Street anticipation, it was a couple thousand short, we've seen stock market take a crash. But jobs are plentiful. We have actually still 2 jobs for every person who wants a job. So the labor market is tilting towards the employee, meaning that they're really calling the shots. And I've actually floated out a resume just to see what kind of job offers. So I floated out a resume of sorts. I don't know, I got 20 different offers from around the country. It was pretty amazing. I was really flabbergasted. And I'm a guy that does not have a college. I have plenty of college courses, but I never got a college degree. And of course, whether that matters in the industry that you're an expert in, I don't know. And this is one of the arguments against or for whatever college you're thinking about, and Joe Biden's gift of $10,000 forgiveness of debt. Wherever you fall out on that, I'm just saying the job market's pretty strong. Okay, a couple of random things which I thought were also interesting, but also indicative of where we are in the U.S. in terms of our own inflation rate. So I looked at inflation rates, and we talked about it on the show a couple of weeks ago. Turkey's inflation rate. Guess what it is, Daryl?
300%.
No, that's a pretty good number, but no, it's 80%. So if you're thinking it's bad here, now we always talk about countries like Venezuela and Argentina, the typical Western Hemisphere inflationary giants, I guess, because whenever the world economy goes bad, these 2 economies seem to have inflation that runs just super hot. Well, Turkey, which is on the other side of the world, in a very different environment, their inflation rate is 80%. So last year you bought a loaf of bread at $1. This year it cost you $1.80. Nice, huh? Oh, glad you weren't there. That's for sure. At least on prices. I don't know about the country itself. Okay. Another thing that was very, very strange, but also indicative of the different kinds of market. There's a new guy down in Florida, 25 years old. He's running for Congress. He's the first Gen Zer to run for Congress. Probably is going to win. In regards, or in conjunction with that, smoking weed more popular than smoking cigarettes. Now, as a cumulative, smoking anything is probably not great for you, not great for your lungs, but it's just interesting. I remember, in the stupid story, back in when I went to college, and this is back in the 70s, smoking weed was considered, you were an outcast, you were, it was illegal, you were, any number of things that people would look at you sideways. Well, something like this that says smoking weed more popular than smoking cigarettes just shows you, and I don't want to say how far we've come because that indicates we've gone somewhere forward. I don't know whether that's forward or backward, but it's just a very interesting statistic, and I thought it's something I should bring to you. Video streaming, bigger than cable. That's very interesting because there was a time, and 1980s, and we seem to be retro on 1980s, whether it's inflation or this particular statistic. Cable was it. And when you got cable, and we all stole cable with illegal cable boxes back in the day, and we all were trying to get in on that HBO thing. What is that? It's this, this movie thing where you could watch movies, without having to see commercials. Well, we now see that streaming itself, which is a internet-based service, whether it's Netflix or Hulu or HBO Max or any number of different services, are more popular than what's on cable. And as an indication of that, get a call the other day. I think, Daryl, you were talking about this. And the person who was with the cable company just said, yeah, we don't care. Go ahead, leave. Is that what they told you?
Yeah, they are not jostling for your business anymore because they know that they can't compete.
They can't compete. So that infrastructure must have cost, I don't know, $1 trillion nationwide, and what's going to happen to it? I don't know. Right? This is part of you. Like, where's that 8-track tape you had? Or where's the cassette tape? Or where's the CD?
8-track tapes on the side of the road.
Exactly.
I still have a bunch of cassettes and CDs.
It's amazing. And you know what? People are going to say the same thing about gasoline-powered cars. Maybe not now, maybe not 20 years, but 50 years from now, they're going to say, hey, whatever happened? What was that? You put gas and you burned it, and it just didn't make any sense. Anyway, these are the sign of things to come. Yeah?
I was just going to say we've had some power brownout sort of here in this area where they challenge you to not use your power as much. They say don't plug in your car.
Oh, I know. I mean, Gavin Newsom. I mean, this is politics at its best, right? He's saying by 2035, we're going to have no gasoline-powered cars sold in California, right? Next day he comes out and says, hey, stop charging your cars. We're running low on the grid. Okay. Maybe we should all have our own charging stations at home, so whereby we power with our own particular sunlight, and we don't really need the grid at all. Yeah, that's what we should be given, an option to do that, because then we don't have to feed into this. Anyway, a couple other things. 3 reasons. I got about 40 seconds left. 3 reasons now is a good time to buy. This is what I promised you. Number 1, prices are dropping. That's true. Number 2, competition is less. That's also true, so you don't have to outbid the next person. And number 3, still legs in the price appreciation. Yes, if you bought now, you're probably still going to see the price of the house you bought in a year from now go up. Now, maybe not 20%, but 3 to 5%, and that's a good thing if you're an FHA buyer and you want to get rid of that PMI. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.